So we are now on question number C. Critically interpret how changes in the market interest rates, YTM, will affect the bond prices in Zambia's financial markets. So we need to understand that our relationship that exists between the bond prices and the yield to maturity is inverse. Okay, so graphically you can show that, but what I can say is that there's naturally an inverse relationship. So when the YTM rises, the existing bond prices will fall because the new bonds will offer better returns. And conversely, when the YTM falls, the existing prices will rise. So graphically, the relationship looks like this. So this is P1 and P2. YTM1, YTM2. So this is how the relationship is like demand and the law of demand. So in the Zambian context, interest rates they change by the Bank of Zambia's influence, their influence to the yield curve. So the investors' sentiments as well have a direct effect on the prices. So for instance, if the Bank of Zambia will increase the policy rate, the bond yields will increase and the prices will drop. So this can impact investor demand in the securities exchange. So the implication here we have is that when investors are holding long-term bonds, they may face what are called capital losses in the rising interest rate environment. So we need to really understand how the bonds behave. Okay, unless there are any questions on that. So this is just the behavior of bonds. So there exists a fundamental principle of this inverse relationship in the market. So when the market interest rates will go up or increase, the bonds will decline. So this is because the fixed coupon payments that emanate from the existing bonds will become what? Less attractive compared to the new bonds that will be in offer. And conversely, when the market interest rates will fall, the existing bonds will become more valuable. So this will drive prices go up. So this relationship is rooted in the fixed nature of the coupon bonds. So I've talked about the Zambian context. It plays a very crucial role in setting the monetary policy rate, which will affect the overall interest rates in the economy. So any adjustments to the Bank of Zambia policy will directly influence the shape of what we call a yield curve. So here investors, the expectations will be affected. All right. So this is on part C. And we go to
Collins, before you move, so
uh-huh.
I don't know. I'm confusing the exchange rate. How does it come in? Does it affect the price of the bonds, or it's just the interest rate that we're talking about, not the exchange rate?
There's a question there. Does the
No,
exchange rate affect the bonds? Uh,
they also affect.
do exchange rates
Okay.
affect bonds? Yes, exchange rates can significantly affect the bond prices and yields, especially when these bonds are dominated in foreign currencies, because we have different types of bonds, by the way. They are foreign bonds. So of course, this is not what we're talking about here now, but since we've talked about this, was they're what we call foreign bonds. So if a Zambian investor is buying a bond that is dominated in US, any depreciation of the Zambian kwacha against the US dollar will increase the value of the bond. And conversely, this is what happens. If the kwacha will appreciate, the investor will earn less. So these are types of bonds. We have different types of bonds. We have Euro bonds, we have foreign bonds. Which other bonds we have? I think I was teaching this in the other class. So it does. Okay. So uh, has that been clarified? So we have government bonds.
Yes.
Okay. All right. So we go to the next question at D. List and explain three categorizations of government bonds. Three categorizations of government bonds. What are they? Categorizations of government bonds.
So Collins, just to understand this question. So this question was not asking us to list the types of bonds.
The categorizations of bonds.
Um,
Uh-huh. So they are in terms of what? They are maturities. We have the short-term government securities, which are the treasury bills. These ones are sold at a discount. They don't um, give any periodic interests. Okay, they're common in Zambia through the Bank of Zambia auctions. We also have the treasury bonds. Okay, these are the medium term. They are over a year. And we also have, what is the last category of bonds? I spoke about this in class. Three categorizations.
is it the long term, the one that matures to 15 years?
Yes, more than 10 years. Yes, what are they?
T-bonds, treasury bonds.
Yes, treasury bonds. Yes. So these are the categorizations. When you're being asked for categorizations, these are the three categorizations. Okay? I repeat, categorizations of the bonds will depend on the period of maturity. So we have the treasury bonds. The treasury bonds are short-term government securities with less than a year. They are sold at a discount. They don't display any periodic interest. They are common in Zambia through Bank of Zambia. We also have what we call the uh, treasury notes between 2 to 10 years. These are medium term, I can say. Okay. They're designed for individual retail investors. Sometimes you can also call them savings bonds. They have lower minimum investment amounts. They promote public participation. And then we have the treasury bond, um, the treasury bonds. Okay. Treasury bonds are for more than 10 years. These are for the long-term projects. Okay. Medium to long-term projects. So they pay semi-annual fixed interest coupons and they're used to finance infrastructure or fiscal deficits. Next question. You are advising the Zambian high net worth individuals, HNWI, who recently began investing in foreign equities as part of a portfolio diversification strategy. One of their investments is in stock A listed in foreign exchange. The investor purchased 100 shares at $20 each, representing an initial investment of $2,000. The stock pays an annual dividend of 5%, which the investor chooses to automatically reinvest, acquiring an additional shares. At the end of the year, the market price of the stock is $22. The investor seeks to understand the their total um, return, accounting for both price appreciation and dividend investment. So calculate the total return on the investment over the 1 year period, showing all relevant steps, including dividend income and investment shares, capital gain, and total return formula. Then interpret the total return figure in the context of portfolio performance evaluation. How does dividend reinvestment affect long-term wealth accumulation, particularly the Zambian investors seeking foreign exposure? And critically discuss two risks that a Zambian investor might face in investing in foreign equities, such as stock A, even when returns are positive, and consider both financial and macro factors. So it was a detailed question. So how did you confront this? Okay, arising from um, this earlier part. Anyone? Okay, which part? How did you answer this? This is what you wrote, isn't it?
Yes, yes.
Mhm. How did you confront this? It's a very detailed question. So how do we calculate the total return on the investment for the year? The total return is what? The ending value minus initial investment over initial investment, isn't it? Times 100. So what was our initial investment? We had 100 shares times $20. So our initial investment was how much?
2,000.
It was 4,000.
Eh?
I mean, initial investment.
Mm-hmm.
$2,000.
It was 2,000. 2,000.
2000. Let me, where do I get my marker? Okay. It was 2000. Where are you getting the 2000 from?
It's in the question.
The 2000 times the number of shares. How many shares do we have?
But it says the
Shares
investor
were
purchased
100.
100 shares
Mm-hmm.
Shares were
at
100.
20%.
The shares
Or
were?
100.
100 shares.
Yes. Okay. The
So
shares were
at 20,
100 times $20, which is 2000.
which
You're
is
right.
2,000.
Yes.
Oh, correct. You're right.
Mm.
2000.
The question is,
Yes, it's correct. I was trying to highlight. Okay, so this is those are calculated already. Yes. What else do we have?
yes,
Our annual dividend.
5%.
Okay, it was 5% of 5% of the what? Of the $20, isn't it? So it is, which gives us $1 per share. And what was our total dividend? Meaning our total dividend should have been that $1 per share times the 100 shares that we have, which is coming to about 100 what? $100. Now dividends reinvested. The dividends reinvested. How do we calculate the dividends reinvested? We divide the $100 divided by the $20. So meaning we are looking at 5 shares there. So that gives us how many shares at the end of the year? The total number of shares was 100 plus the 5. So we have 105.
105.
Yes. Then what was our ending price per share?
22.
$22, correct. So meaning what becomes the final value? The 22
Will
times
it be?
the 105, isn't it?
Mm,
So which
Yes,
is
Collins, are you writing somewhere? Maybe we're not seeing that part.
um no, I'm not writing. I'll be writing. I want you to first to get these ones before I write.
Okay. Okay.
So meaning we need to um calculate. So that becomes what is 105 times 22?
2,310.
2310. Okay.
Yes.
So meaning that 2310 will be our ending value, right? So
Mm-hmm.
we can calculate the total return. What is the total return? Ending value minus what?
Minus
Minus
the
initial
initial.
investment. Okay, so meaning our ending value is how much?
2,310 minus 2,000, is it?
Yes. So um, at least we know where the figures are coming from. So our initial investment we have established was how much? 2000. Okay, 2000 has been given in there. Then our ending value has been calculated based on the capital gain. So this is a 2000 here. He calculated our annual dividend, which was 5%. Are you seeing my screen?
Yes.
5% of the 20, which gave us a dollar per share. So the total dividend, this was just helping us to calculate how many dividends were reinvested. So multiply the 100 shares by the $1, which was 100. So we divided this by the $20 to get the 5 additional shares that we had, giving us a total shares at the end of the year, 105. Then the ending value was given in the question by $22. So meaning the value of these 22 of these 105 shares gave us 23.10. So meaning the difference between the 23.10 and the 2000 is our capital gain. So to calculate the total return, it's the end value, which is 2310 minus our initial investment, 2000 over 2000 times 100, which gave us about 15.5%. All right. Are we together? Are we together so far?
Yes.
Yes, we are following.
Okay. Let me send that before I proceed. Then we go back to the second part. So it was imperative to have all those calculated because they were all being asked for. We needed to calculate the what? The step by step, the dividend income, the invested shares, the capital gain, and the total return formula. So all these are being shown. All right. Then secondly, interpret the total return figure in the context of portfolio performance evaluation. So um, what does that
So Colin, are we done with this question?
yes, we are done with this question, the 10 marks. All the elements have been,
Also,
yes,
also everything is here in the same answer.
yes. All right. So question is, what does the 15.5 interpret? What is the interpretation of that 15.5? So the 15.5 is the return over the year. So what this simply means is that the period of 1 year shows that it's a strong indicator of the investment performance, especially when both capital gains and investment dividend investments are being considered. So this return is actually reflecting the investor's ability to generate wealth from two sources. Number one, the increase in the share price from 20 to $22. That's about a 10% capital gain. And also the 5% dividend income, which was successfully reinvested. Okay, from 100 to 105, that's just 5%. Okay, the difference. So the reinvestment not only showed the increase in the number of shares held, but also contributed to a higher final portfolio value. So this is simply demonstrating uh, the power of compounding. So in the context of portfolio performance, this result here supports the principle of total return analysis, which looks beyond just price appreciation. It also includes income and reinvestment effects. So for the high net worth individuals, HNWs, especially those in Zambia, who are seeking global exposure, like a comprehensive analysis, it will help them in making informed decisions about asset allocation. So this also demonstrates that there's a well-chosen foreign equity when supported by a sound investment strategy that an institution may put on. And this may help to outperform many traditional and domestic investment options. So also you could comment it in terms of the risk profile. So the overall risk return profile of the investor is diversified. So it indicates that it indicates that including equities like stock A can serve effective hedge against local economic shocks in Zambia in the face of inflation. So more important, this figure also emphasizes on long-term investment planning and regular monitoring of portfolio performance. Okay, so that is how you can comment on it. This is carrying how many marks? It's carrying um
5.
5 marks. Okay, so I hope that is clear. I'll be sending the notes so that you can read through in case they're repeated. Okay, the next question is asking for us to critically discuss two risks that Zambian investors might face when investing in equities such as stock A, while when returns are positive, and consider both financial and macroeconomic factors. So, what uh, two risks can we talk about when we are dealing with investing in foreign countries?
So maybe the
Exchange
exchange rate, can it be
Pardon?
exchange risks.
the
Yes,
exchange rate?
foreign exchange rate and political, or yes, political risk, or even regulatory risk can be in one umbrella. These are the common risks, okay, that we can expect when you're dealing with a foreign nation. So, how does exchange uh, or foreign exchange risk come about? So, when you're dealing with foreign exchange risk, most of significant risks that Zambian investors might face um, arising from fluctuations in the exchange rates of the Zambian kwacha against the US dollar. When a foreign stock like stock A in this case performs well in the local market, there will be currency depreciation in Zambia. This will erode the actual investment that you expect from the actual return. So in this instance, if stock A maybe appreciates by 15% in the US dollar, but during the same period, it depreciates by 10% against the US dollar. So the effective quarter return would be much lower in the negative. So we have unexpected losses emanating from there. Then also the political and regulatory risk in the host country. So there's another major concern. So in politics, like right now, um, where foreign equity is listed, so changes in government policies like capital controls, tax regulations, or restrictions in foreign ownership, these can directly affect the value and accessibility or transferability of these investments. For instance, if a country introduce withholding tax on dividends for foreign investors, so to reduce their net worth. So it's an important aspect to look at when you're dealing with investors, particularly who are vulnerable to risks due to their geographic or political distances. So it's important to consider such risks that may be there. So it's therefore, of course, important to consider diversification on a global, as a global strategy, but it has its own risks. So you need to see whether these risks outweigh uh, the gains that you may have uh, if you're to invest locally. Okay, so these questions were bulky. Time has elapsed. We'll end here for tonight.